Welcome to the Trade Management segment of Trading in Sidebars. Find setups today, make money tomorrow. I'm your instructor, Frank Bunn. Follow-through, although random, should demonstrate predictable behavior with known variation. This characteristic facilitates tactical trade management. Let's take a look at the pattern credentials. We have our price action pattern key plus our context. Here we have no divergence either with the price action or the trend. We also have the proper expansion and contraction flow going into the pattern. So our higher highs for longs and lower lows for short are confirmed. Therefore, entering the pattern from momentum and impulse into the setup itself, we have a high momentum expansion phase that is constructive. So we are looking at the pattern key plus expansion. Next, let's take a look at a few tools we will need to effectively manage these breakouts. To begin, we'll take a look at the scalper's role. It involves selling strength with long positions or covering weakness with short positions, or selling divergence with long positions and covering divergence with short positions. The scalper's role will help us effectively close positions and exit for profit when momentum is no longer constructive. The next tool we want to use is our counter trend line. To establish the counter trend line with the inside bar pattern, we connect point 1 high or low to the inside bar high or low. This trend line may or may not be broken at the entry bar. More on this in a bit. But remember, if you have the proper chart tools, you will be able to magnetically connect these highs and lows for accuracy. This is extremely important. The next tool we want to look at is our 3-6 MACD confirmation. The 3-6 MACD confirms when our new price high, or low for short, corresponds to a new indicator high, or low for short, since the zero line has crossed. In this chart graphic, we can see that as the pattern breaks out, we have a higher high on the 3-6 MACD indicator, higher than that of the inside bar and the point 1 bar. This is crucial. Please do not proceed until you thoroughly understand this concept. You will want to sit in breakouts that confirm. This is an extremely important trade management tactic. Let's take a look at the breakout phenomenon with the 1 bar follow through. Here we see that the entry interval or breakout bar exceeds point 1. Therefore, for longs, we are looking for a definitive close over point 1, as seen here in the chart graphic, and for shorts, we see a definitive close below point 1, as seen here in the chart graphic. This produces immediate explosive gain, and we'll call this the breakout confirmation. Let's take a minute to discuss the follow-through golden rule. If we have big range up on our interval with expanding volume and a breakout confirmation, we can expect higher prices to come. Conversely, for shorts, if we have a big range interval down with expanding volume and a breakout confirmation or definitive close below point 1, we can expect lower prices to come. The biggest advantage of the inside bar pattern is that we immediately can confirm our breakout. You know right away whether or not these are working. So we can use intuitive management then to kill our breakout failures and sit with winners. Here's an example of a long follow-through with the golden rule. We see a big range at the breakout with expanding volume and constructive momentum. More on this in a minute, and we can see we have higher prices to come. We are going to use this definitive follow-through to establish a break-even stop. If we have a breakout confirmation or definitive close over point 1 for longs, or a definitive close less than point 1 for shorts, we will set our break-even stop. Here in the chart graphic, we can see that with the definitive close over or under point 1, we simply move a break-even stop. Let's take a look at our long example again to analyze follow-through to break even. Here at our follow-through bar and definitive close over point 1, we move a break-even stop at the close of that interval. The next tool we will be using is the staircase pattern. The staircase pattern is a series of uninterrupted higher lows for long or lower highs for shorts from impulse through follow-through. The most effective way to trade inside bar patterns is to climb on the momentum that's established with higher highs and higher lows and ride the trade as long as it continues to exhibit that constructive momentum. The staircase pattern will help you do this. We'll see more on this in just a minute. Let's take a look at how we can use our intuition to confirm our breakouts. Remember, our stops will be the breakout bar high or low plus or minus 5 cents. We move our break-even stop after we have our definitive breakout confirmation. Also, price should close over or under our counter trend line. Determining breakout confirmation is how you want to begin to employ your advanced trade management tactics. We do not want to treat every breakout the same. You want to wait for confirmation and then sit. Intuitive confirmation can also be a surrogate for the R game. We analyze our price action trends and manage breakout failures. This also facilitates advanced targeting. Once we confirm breakouts, we can establish targets. Effective trade management with the inside bar pattern depends entirely on what occurs after the price breaks the inside bar range. What is most likely to occur is a continuation of the trend. The best traders are able to calibrate management activity pursuant to random outcomes and still maintain discipline and structure. Let's take a look at the specific management tools then we will use. First is our point 1 level. Next, we have our counter trend line. Following this, we have our 3-period exponential moving average and our 3/6-period MACD indicator. In addition to these tools, we have the staircase pattern itself, our risk, high and low stops, and our Fibonacci extensions for targeting. So let's take a look at how we're going to put all this together. Remember, trade management is about determining constructive momentum. The same constructive momentum that preceded the inside bar pattern should exist with the breakout. This enables us to sit until constructive momentum no longer exists, at which point we exit the trade for profit. In this long example, we're going to look at how we will employ all of our trade management tools. Our point 1 level will confirm our breakouts. We have our counter trend line, the 3-period exponential moving average so we can determine divergence, our 3/6-period MACD indicator so that we can both confirm trades and establish divergence, the staircase pattern, and risk. With this particular setup, notice that at follow-through, prices continue to test or trade through the 3-period exponential moving average. Also, notice how at the breakout confirmation, the 3/6-period MACD indicator confirmed the breakout. That is, we had a higher high in the indicator with a higher high in price. This is exactly what you want to see in your breakouts, confirmation on all points. Conversely, let's take a look at this short example. Here we see all of our tools and confirmation. The follow-through intervals either trade through or test the 3-period exponential moving average, and the 3/6 MACD indicator confirms the lower lows. Notice how the indicator registers a lower low since crossing the zero line with new lows in price. This is extremely important. This is how you will be able to determine on each trade whether or not you should be sitting or taking profit. Let's revisit the grand law of price. Price remains in constant flux between divergence and reversion to the mean. The most likely consequence of divergence is reaction or adverse price movement. We do not want to tolerate adverse price movement with inside bar breakouts. We want to see a continuation of the momentum. Therefore, we will use the 3 exponential moving average to determine price action divergence. Price action is considered to be diverged when we have the evolution of a complete interval in which price neither tests nor trades through the 3 exponential moving average. We see an example of divergence here in the chart graphic on the right. Notice how the intervals completely evolve above the 3 exponential moving average. Trend divergence is visual using the 3/6 MACD indicator. Trend is considered to be diverged when higher highs on a long trade or lower lows on a short trade are not confirmed by higher highs or lower lows on the 3/6 MACD indicator. In the chart graphic on the right, we see an example of this. Notice how the higher highs in price are not confirmed by the indicator. This is how you can tell immediately if your trade breakout is behaving properly. Let's take a look at the 3 EMA surfing phenomenon to tell when we can sit in trades for more profit. 3 exponential moving average surfing is defined as 3 or more tests of the 3 exponential moving average line from impulse through breakout and follow through. Mathematically, an exponential moving average test for longs is calculated when the open is greater than the EMA, the close is less than the EMA, and the low is lower than the EMA. Conversely, for shorts, we mathematically determine a test when the open is less than the exponential moving average, the close is less than the exponential moving average, and the high is greater than the average. In the chart graphic on the right, we can see the third exponential moving average test of the 3 EMA line. This establishes surfing. Here we can see an example of an actual chart setup with 3 exponential moving average surfing. Notice that at the third white arrow, we established the surf. Price has tested the 3 exponential moving average at the first 2 white arrows. This enables us to sit through reactions, but remember, highs must be confirmed by your MACD and price should remain over the 0.1 level. Once we have breakout confirmation, we can manage our trades with a risk-based game. First, by establishing maximum risk of 1R. We extrapolate 2 to 5R, depending on our context, and create these R levels on the chart. Our objective with a risk-based game is to push reward to risk in the trader's favor of 1 to 2 or greater, preferably 1 to 3. But we must know when to play a risk-based game, only when we have our breakout confirmation. We manage the trade intuitively when we have breakout failures. Trading in sidebars with the staircase pattern is ideal for mechanical management. Here, we will use interval low stops with the staircase pattern, beginning with the breakout bar high or low. We will trail our stop 5 cents below each complete interval. We will reverse this for shorts using the highs. Here's a strategy tip. Combine your trailing interval stops with an R target, such as a 2 or 3R target. This will help you reduce or eliminate risk quickly, giving you big winners and no stress. In the chart graphic on the right, we can see how stops would be moved 5 cents below the lows as the staircase pattern continues to evolve. Let's take a look at how you can use advanced targeting to complement your R targets and the scalper's rule, which is to sell strength and buy weakness. This is an effective method for risk shedding, and the tool of choice is the Fibonacci extension. We will establish the extension with 3 points. First is the lowest low in the impulse. Point 2 is the high which precedes the inside interval. And point 3 is the inside bar low itself, as seen here in the chart graphic. This is how you properly draw Fibonacci extensions for inside bar patterns. Let's take a look at this targeting with a recent long example. Here we can see point 1 at the low of the impulse. Point 2 is the high which precedes the evolution of the inside bar. And point 3 is the low of the inside bar. This gives us Fibonacci extensions here we can see at 0.382 and 0.618 for advanced targets. The inside bar pattern objective is to get immediate price rejection over 0.1, which enables you to get the trade to break even. You also must recognize constructive price momentum. The same constructive price momentum that preceded the inside bar pattern should continue with your breakout. We can use the staircase pattern to analyze this, plus mechanical management. Remember, you want to exit into strength or weakness and exit diverged conditions immediately, combining targets with the scalper's rule. The best way to do this is to calibrate trade management activity with exactly what is going on. The inside bar trade management focus requires that we exit the trade when momentum is no longer constructive. High momentum will cause price action to diverge quickly. Reactions will cause trend divergence as new pivot highs and lows become unconfirmed. Use the following trade management plan to effectively trade your inside bar setups. First, establish a maximum risk stop. Calibrate the procedure for your point 1 breakout. If you have a breakout failure, move your high or low stop. If you have a breakout confirmation, move the stop to break even. Next, establish your targets, either with an R-game or your Fibonacci extension tool. Meanwhile, look for 3 exponential moving average surfing so that you can sit through lower low or higher high reactions. And also look for constructive expansion where you do not have divergence, using your mechanical management and targeting trade management tactics. Then exit divergence, either price action divergence or trend divergence at the interval close. Keep in mind that divergence may be stopped or exited immediately. Trade management can be as simple as exiting hesitant breakouts and holding patterns which evolve the 1-bar follow-through. You will see this occur over and over again on any time interval. Master this simple pattern and you will consistently profit for as long as you trade. The inside bar pattern is a brief contraction in an expansion phase of institutional accumulation or distribution. The best trade management procedure will not tolerate adverse price movement in the form of lower lows or higher highs unless significant price rejection has occurred, and a reaction is unlikely to trigger break-even stops. What happens next? We put it all together to learn the anatomy of an inside bar trade. Remember that our goal is 85% winners. Do this before you proceed. Be certain to review all the mechanics covered so far: pattern logic, technical requirements, determining trends, setup and risk control, and trade management. You must understand proper setup structure in order to effectively pull the trigger. This concludes the trade management segment of Trading in Sidebars. Find setups today, make money tomorrow. I'm your instructor, Frank Bunn.